Welcome back to the Lone Ranger Radio Show. You got Bruce Woodburn CrossCountry Mortgage, and yes, I am the Lone Ranger. That's right. That's right. You got the Lone Ranger. We got a lot of things to cover here today, and we got to get right down to it. So, what do we got going on here? We got a great week last week in the market. Great week, or it was this week, I should say. So, we saw some major improvements in interest rates. Now, are they drastic enough to where I want you to just jump in and refi right now? No. So here's my message to everyone out there. So pay close attention. If you own a home and your interest rate is north of, say, 6.5%, and you want to lower your interest rate and reduce your payment or eliminate PMI, do not do it right now. I think that we could get a little better as time goes on. The thing is I don't know when we're going to get better. We could get better in a month. It could be 6 months. It could be 2 years. I don't know that. But what you don't want to do is what lenders love for you to do, and that's called churning your mortgage. It's actually an insurance term, and I believe it's even illegal in the insurance world. But it's churning. That means you keep refinancing and chasing a lower rate, but you're chewing up equity every time you do that. And if you're a veteran and you're trying to do a VA IRL, which is a rate reduction refi, you can only do it every 241 days. So if you do it now and then rates drop significantly between now and the next 241 days, you can't do it. You're missing out, not going to be able to do it. So don't do it. So here's what I'm suggesting you do. I created a VIP watch list for all of the clients that I've closed since February of 2022, because that's when rates started to go up. And I promised every one of them I would refinance them with no lender fees when the rates got to a target rate that I think was attractive enough. And I'm thinking 5.5 to 5.25, because I don't think you guys are ever going to see 4s or 3s ever again. So 5.5, 5.25 is a good target. So I created this watch list. I had about 325 people on it. I brought it up on my radio show, and now all you guys are like, can I get on your VIP watch list? So here's the thing. I am not going to keep that VIP watch list for my current clients only. I will extend it to my radio listeners. You're valuable. You've been loyal to me. You guys are all out finding friends and family that you can refer to me, and I'm grateful that you would do that. I will pass on this. So if you want to reduce your rate, reduce your interest rate, reduce your payment, eliminate PMI, don't do anything other than call or text me. I'm going to want a copy of your mortgage statement. I want to know what rate you're at. And then I will add you to my watch list. And when it hits that target, we will refinance your home. In the meantime, don't be convinced to do anything with these other lenders. I know rates are attractive. I know they're getting lower. You could even possibly save money, but don't keep doing it. Don't fall for it. It's a mortgage gimmick trick, and I don't want you to fall for it. Okay. That's why I'm here. I'm here as the truth teller. I'll tell you what other mortgage companies do that are shady. I'll tell you what they do. I see it every day. It's shady business, and you don't want to get caught up in it. Now, on the other hand, if you own a home, you have got equity in the home, but you are also loaded with consumer debt. You're drowning in debt. You've got car loans, credit card loans. You had your dental surgery, your boob job. I don't know what it was you paid for, but you're loaded with debt. And we've got to get this under control, because debt is the enemy of wealth. So we need to look at either doing a debt consolidation for a home equity line of credit, or we need to refinance. Now, many of you don't want to refinance because you have a 3.5% 30-year fixed rate on your home. But I want to tell you a story about Judy that called me. This was probably 3-4 months ago, but it rang really true to me. Judy and her husband had a 3.5% 30-year fixed rate with a $1,500 mortgage payment. She wanted to do a home equity line of credit to consolidate her credit cards and pull out 25,000. The 25,000 on a HELOC would have cost her 300. If I consolidated all of her debts into a HELOC, it would have reduced her total payments by about $500 a month. Not too bad. But remember, HELOCs are 10-year term and most of them are adjustable rate tied to prime. So I looked at it and I said, Judy, why don't we just consolidate everything and put it all in one mortgage? I know, Bruce, but I don't want to give up the 3.5%. And right now, interest rates were 6.75. I ran the payments by giving her 25,000 cash to do her home improvements, pay off both cars, pay off all the credit cards, which was 1,500 a month, and pay off her house. So listen, hear me out. All of her debts combined at the time, if I gave her the 25 grand, were $5,000 a month, 5 grand a month. I refinanced the whole thing, gave her 25 grand. Now she has one debt, and that's a mortgage. And that debt is now $2,000 a month. Excuse me, $2,500 a month. So I saved her $2,500 per month. Now, listen, she came to me and she goes, I know I'm happy, Bruce. It's saving me a lot of money. I just hate putting my cars on my mortgage for 30 years. And I said, Judy, don't pay them in 30 years. Take that $2,500 a month that I'm saving you and put it back on that mortgage. Now your mortgage is paid off in 8.3 years. Now you have no car loans, no credit cards. You got your house fixed and you have no mortgage in 8.3 years. That's how you do it. She said, that's great, but I really like the idea of saving some money. So pay $2,000 a month extra toward your mortgage, and it pays off in 10 years instead of 8 years, and you're still saving $500 a month. And that's what we did. And that's the game plans that we come up with here. 407-706-3313. Write that number down. That's Orlando, all the way to Jacksonville, all the way down to Lakeland. 407-706-3313. Tampa Bay, all the way from Cape Coral, all the way to Lakeland, all the way up into Spring Hill. You can reach me at 813-213-4009. That's 813-213-4009, or go to webringyouhome.com. That's webringyouhome.com. Call me, text me, send me a courier pigeon, but whatever you do, you got to get a hold of me. Let's get this fixed for you. Let's become a homeowner. Let's fix your debt. Let's consolidate. So I want to talk about interest rates. Okay. Stock market took a bit of a hit at the beginning of the week, right? That really helped interest rates. Joblessness claims were up. That means more unemployment. That helped interest rates. We don't need the Fed to drop the Fed rate. I don't need Trump to convince Powell to drop the Fed rate. Leave it alone for now. Just leave it. Interest rates will improve on their own as the bond market improves. But every time we had the Fed drop the Fed rate, rates got worse for mortgages. So don't do that. Now, you have to understand why they get worse when the Fed drops the Fed rate. Now, they don't always, but they do most of the time. So you have to understand, first of all, why would the Fed drop the Fed rate or increase a Fed rate? To stimulate or slow down the market. They drop the rate to stimulate the market. They increase the interest rates on the Fed rate to slow down the market, to avoid inflation. So back in 2022, they did 3 increases rapidly, and it just slowed the market down to a grinding halt. Well, September of 2024, they dropped the rate by 0.5 point. Rates went from 6.25% back up to 7.5%. They went worse. They got worse, even though the Fed dropped 0.5 point. So they drop it another 1/4 point in November. They drop it another 1/4 point in December. We've actually dropped by a full point, and yet rates are higher today than the day before they dropped it the first time. Why does that happen? Understand the dynamic. Understand the relationship between stocks and bonds. Institutional money, big money, when they are when they are moving money around, they make money when stocks are doing well. So they move everything into the stock market. And then when they are when the market is unstable, they move into the bond market because the bond market is safe. They don't make money in the bond market or not much, but they have safety. So it really gives them a great deal of sense of protection. So when the stock market, excuse me, I got a little distracted there. When the Fed drops the Fed rate, it stimulates the market, it stimulates the stock market and pulls the energy out of the bond market. And that's what drove interest rates up. We want the bonds to be high. So I don't want the Fed to do anything with the Fed rate. Right now, we're starting to see some improvements. Interest rates are getting much better. We've seen the best week that we've had, I don't know, probably in 6 months. So it's been a great week, but it's still not the time to refinance unless you're looking for debt consolidation. But it is a time for you to get off your butt and go buy a home. That's what it is time to do. So you should be looking in the market right now. Why should you buy now, even though I'm discouraging people from refinancing for reduction of rate? Here's why. Right now, you've got a more balanced market than we've seen in 10 years. That means it's not a seller's market. It's not a buyer's market. It's a balanced market. But the thing is, it's really acting like a buyer's market because there's a large amount of inventory. Now, even though our inventory is starting to shrink again, we had 5 months. Now we got about 4.5 months worth of inventory. It's starting to shrink. I'm starting to see more multiple offers on good properties that are listed for that are priced well. However, I think that if you can just get past the interest rate, you will be able to refinance later. But now you have an opportunity because there's more homes on the market. And when there's more homes on the market, you have more choices to choose from. And when there's more homes on the market, sellers have more competition. So they're more apt to work with you. Reduce the price, pay closing costs, pay for rate buy downs, make repairs, fix the roof, fix the plumbing, fix the electrical, doll the house up. They're more willing to do that when they know there's more competition. But if you wait for interest rates to hit to the fives again, then everyone's going to jump in the market. It's going to be a bidding war again. The sellers don't need to fix anything because they got 10 people wanting the house at the same time. And you are back in the same boat and you're waiting again. Meanwhile, you could buy the home now, suck up the little higher payment with the interest rate. I get it. I get it. I get it. I get it. It's a little bit more painful, but it's a temporary problem. And think how happy you'll be if you have a higher payment now and then interest rates drop, we refinance it, and we save you $300 a month. Then you can apply that extra $300 a month toward the new mortgage, and you'll be paying it off in 15 years or so. These are the opportunities you need to look for. My name is Bruce Woodburn. I'm the loan arranger. I've been in the mortgage business for 35 years. I've closed well over 10,000 transactions. I am ranked one of the top loan officers in the entire country. I don't tell you that to brag. It's my team that does it for you. It's our commitment to excellence. It's our commitment to you. It's our return phone call policy. It's our meet you in person. We care about the outcome for you. That's why we're such good producers. That's why people come back to us time and time again. 407-706-3313. That's 407-706-3313 or 813-213-4009 for my Tampa Bay friends. That's 813-213-4009 or webringyouhome.com. That's webringyouhome.com. When we get back, I want to talk about other opportunities that people have in this market, what investors are doing, and I want you to get anyone you know into my home buyer class on February 18th. Anybody that's renting a property, do not delay. Get them into that class. I'll show them how to become a homeowner. I'll be back in 5.